Hello there and welcome to today's video that I believe outlines the journey or the evolution of an investor. It is based on my own experience as well as my observation of the evolution of other investors. I really hope that you enjoyed this video. It is divided into 5 different segments or 5 different levels. Level 1 being complete beginner or noob, up until level 5 being pro. So let's get started. Level 1 is what I'd like to call the complete beginner or noob level. And at this point, we have no idea which questions to ask. All we have as information is the share price and the opinions of others. So if we focus solely on the share price, well, what we can do is connect that to the real life examples. If you go to the supermarket and you see a 70% discount on one of the items, then you'd consider that it's a good deal. However, if the share price goes down from $100 to $30, it doesn't have to be a good deal. Maybe there are really good reasons why the share price collapsed. But at this level, we have no idea which questions to ask, so therefore we're stuck with the only information at that point, the share price. However, all the companies that went bankrupt, well, their share prices went on that exact trajectory. The tendency to follow the crowd and opinions of others is very common among those who have no experience or education in this area, or knowledge at least, maybe I should use that term. This is also how bubbles form. There's fear of missing out because we don't understand what's going on. We join the rest because someone else made money. And then eventually the bubble pops and everything goes downhill. Why do we follow others? Very simple. When you don't have any knowledge and experience, the opinions of others oftentimes sound logical and smart. Not because they are logical and smart, but because we don't have the ability, the knowledge to see right through them and to question them. Level 2 is being an enthusiast, and at this point you're aware that the share price on its own is not enough to make good investment decisions, so you start exploring the financial statements and learn the basics of accounting. And at some point, for the first time, you can follow the 3 financial statements. I'm not going to lie, when I was at that point, I was in university, it felt like a superpower. It felt like I could analyze any company that this investing thing, I have it figured out. Even though this is just the beginning, of course, it doesn't feel that way. Understanding the financial statements is useful, but not enough to be a great investor. However, now at least you can challenge the opinions of others. Level 3 is another level that you feel like you have superpower because you get exposed to the valuation techniques. You have a little bit more understanding of how multiples work, so an EBITDA multiple, price to earning ratio. Maybe you can build a DCF model even, you can create a dividend discount model. So there are all of these valuation techniques. All of these can be powerful tools, but of course, they're just one piece of the puzzle, even though at that time we're not really aware of that. At some point, you're likely going to stick with 1 or 2 models that work for you and you're going to keep them moving forward. But the problem is having the tools isn't the same as knowing how to use them. So probably at this moment, you have many fancy spreadsheets that, have some inputs that aren't really supported in any meaningful way by solid research other than the financial historical data, which basically leads to garbage in the model, garbage out of the model. However, it feels again like a superpower because there is an outcome. There is an outcome in the form of this is the value of the company, and now you can use that to make decisions. You have estimated the value of the company, you can compare it to the market price, but a model of this kind that is based on poor input could harm you more than it could help you. And by the way, everything that I've covered up until now could be 100% automated. So up until this point, you have no advantage over a simple algorithm. When you invest based on your DCF model, and it turns out to be quite a bad investment decision because of the low quality of your inputs, you level up to level 4, which is you understand how important the inputs to your model are. And now the focus changes. It shifts from focusing on the historical financial data to focusing on doing more research about the industry, the competitors, and just the broader environment. So for example, if you're analyzing a car company, you'd like to see how the competitors are doing. You'd like to see if there's a trend regarding electric vehicles, if there are any regulatory changes that will impact your margins, and so on. So this is when research becomes your best friend. You're no longer looking at your company in isolation. You're connecting the data between your company, the competitors, and everything else that happens outside. So storytelling at this point becomes a part of your process, as now you're not just crunching a spreadsheet. Basically, you're not crunching some numbers in a fancy spreadsheet. You're building a narrative about your company's future. Level 5 is the pinnacle of investing, and in this point, the question evolves around intangibles. And I don't mean goodwill, patents. No. I mean the management team and the culture of the company. And the key questions here to ask are: is the management trustworthy? What is its track record? What is its vision? Can the culture and the company survive tough times? Because sooner or later, there will be tough times. Culture is overlooked, but it's incredibly important. And what I find interesting is if you invest in private companies, you'd get to level 5 much sooner than if you invest in public companies. And here's why. Assume that you have somebody coming to you and asking you for $10,000 for 10% of this new venture, right? So somebody offers you the chance to invest in this new company. The first question that you will have is, who is this person? Do I know him? Do I trust him? If this is somebody who has scammed so many people before, or he's raised funds multiple times and every single time he failed, not even close to succeeding, he was, misleading investors. If he has poor reputation, it doesn't matter what the idea is. The conversation will end there. You would just say, I'm not interested. If the individual has integrity, is someone who has a good track record, you trust that person, then you're going to focus on the second part of the conversation, which is, what is your business idea? Tell me more about it. I'd like to understand if it can succeed in this environment. And then at some point, you're going to try to figure out what is your potential return out of it. And it's interesting that when investing in public companies, the management team and culture isn't mentioned or researched as much. I do think that that is a very, very big mistake. And eventually, of course, after all of these different levels, you get to a conclusion of how important that is. I'll wrap it up as I aim to keep these videos short. I hope that you enjoyed this video. Let me know at what level you are. And as always, thank you for watching, and I'll see you in the next one.